Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with Roger Silk. How you doing today, Roger?
Good, thanks. How are you, Kirk? Thanks for having me on.
Yeah, doing well, doing well. So glad to have you in the show. So Roger, tell us a little bit about your background before we begin.
Well, I have a PhD in applied economics. I was at the World Bank for a couple of years. Then I went and set up and ran a family office for a wealthy family in the early 90s. And then towards the middle of the decade, I left and started Sterling Foundation Management with my current business partner, Jim Lintott.
Nice. What was it like working for the World Bank?
It was very educational. That was my first quote unquote real job out of school. And I was in the Treasury group. And while I was very junior, it was really great because I just got to do interesting stuff. When I advanced a little bit, it became political quite quickly. And so I completed my 2-year contract, and then I went to the other end of things and worked in a very small place. The World Bank is huge, and went to the other end of the spectrum and worked with this private family where wasn't very political.
Nice. When you're working at the World Bank, like what kind of projects do you have? Was it
So I was in the Treasury group, and the World Bank is a little bit of it's a very unusual bank because it's kind of not really a bank. It's more of a quasi-governmental organization. It doesn't take deposits, and the only loans it makes are kind of big international development loans. And so what I was involved with was the part of the World Bank that maintained its reserves, because most banks, they don't lend out all their money. They keep a certain amount of it in cash or cash equivalents. The World Bank is the same. And so this was in the 1980s. The team was managing about $20 billion of essentially what you could think of as a money market fund. And so I was one of those guys. Most of what I did was repo trading. I don't know if repo
Yeah,
trading
tell us what
is
that is.
kind of one of those inside baseball things that so that the US Treasury market these days is, I don't know, it's over $30 trillion of Treasury debt out there, most of which is extremely liquid. Treasury securities. So Treasury securities, everything from short-term T-bills all the way out to 30-year bonds, right? And kind of everything in between, although most of it is what they call the short end of the curve, the yield curve, which is just kind of describes the fact that interest rates on, say, overnight money are probably different from interest rates on 90-day money, different from a year, 2 years, 5 years, 10 years, 20 years, 30 years. Anyway, that's called the yield curve. And most of that Treasury paper, that's when the Treasury borrows money, they issue bills, notes, and bonds. That's called Treasury paper. It trades very actively, but it also, because it's so liquid and considered to be riskless, it's considered very high collateral. So let's say, for example, you are a bond fund, like a money market, a mutual fund, a bond fund. And let's say your mandate calls for you to be basically 100% invested in bond market all the time. If you have large redemptions, you might not want to just dump that paper right away. You might want to borrow the money to pay your withdrawing investors. And so you can pay them right away and then sell your bonds off in an orderly manner or in accordance with whatever your investment strategy is. So what you can do is you can use them as collateral in what's called the repo market to borrow short-term cash. And the flip side is also the same. If you have cash, like you're a money market fund, and you want to put that money to work, but only for a short term, you could lend it out against Treasury collateral in what's called the repo market.
Why would what problems could happen? Because I've heard in the past the repo market, it doesn't come up much, but every once in a while there's like, oh, there's a problem in the repo market. Are there problems that could come from that? Because it's short term. You're talking about like overnight sometimes or a few days or
So most repo is overnight. Yeah. The problems that can come is the way the repo is supposed to work. It's supposed to be, so repo is short for repurchase agreement. So let's say that I am borrowing cash from you. And let's say that I want to borrow $1 million from you. And let's just say I have $1 million treasury bond, right? The market value of my treasury bond is $1 million, let's just say. Okay. So the way repo is supposed to work, I quote unquote sell you that bond for $1 million with the understanding that I will repurchase it tomorrow, right? So that basically you're lending me that money overnight. Does that make sense?
yeah.
Okay. That's all fine until something doesn't work. So if I don't buy it back from you, you're supposed to be able to just turn around and sell it to get your money back, right? That's what makes it relatively riskless for you. Sometimes in bankruptcies, the bankruptcy judges don't get how repo is supposed to work. And so sometimes it's not as liquid as people think it is. I think that happened in the aftermath of the financial crisis, and then again, I can't remember the name of the company, but
Bear Stearns, AIG,
yeah, no, those
Lehman
were in
Brothers.
those were in the financial crisis. Those were much bigger problems. Those weren't just repo problems. Now, remember Corzine, the
Oh, MF Global.
MF Global, yeah. My recollection is the judge didn't really get it, and so there was a lot of repo funds that were locked up for several weeks while somebody explained to the judge how it was supposed to work. Other than that, I think the repo market is sometimes in the news because when there's stress in the money market, it shows up in the repo market, and it's really money market stress, and that's why we sometimes hear about the repo market. But it's really one of those kind of inside baseball things that doesn't affect most people directly, even though your money market, if you have money in a money market fund, chances are good that a lot of that money is actually in the repo market.
Okay, cool.
So yeah, so it was a really great experience, the opportunity, because how it's one thing to read about something, it's another thing to actually participate in it. And that was probably, I kind of got a real education in money markets by basically being an active participant for a couple of years, and that was super valuable as one of the things you learn in finance is the value of any asset is the present value of its future cash flows. And the present value of the future cash flows, obviously one of the big determinants of that is the discount rate, the interest rate that you're using. And so kind of understanding the money markets kind of helps give anybody who does it, I think, a better perspective on how all that works.
So how do, just as an example, we've had basically 0% interest rates for close to 20 years, and now they're higher. How do higher interest rates impact things like, valuations due to discounted cash flows and, your, how does it affect all these different markets when you have higher rates?
Well, everything else equal, higher interest rates means lower asset values. And so here's one way to think about it. Suppose interest rates were actually honest to God zero and everyone believed that they were going to remain zero forever. Right? In that circumstance, there's theoretically no limit to the value that someone will be willing to pay for an asset, because a dollar in a year is worth just, that's what zero interest rates mean, is that a dollar in a year is worth just as much as a dollar today. Now, one of the things that kind of got glossed over in the zero interest rate period is the fact that only very select interest rates were ever zero. First of all, they were only mostly short-term rates, at least in US dollar. In some of the foreign currencies, they had negative interest rates, as you probably remember.
Yep.
And I think the way to think about those negative interest rates is really they're just a hidden tax. They were an undeclared tax, because some of the places that impose negative interest rates basically require, unless you could get the money and literally keep it in paper cash, which isn't very practical for most things. You got to keep it in a bank, and the bank is very closely connected to the government. And so the government imposes the negative interest rate, which is essentially a tax, right? It's essentially a fee for keeping your money at the bank. I think that's one way to think about it. So interest rates were never really zero for most people. And well, for no individuals, right? Even when interest rates were zero, if you wanted to borrow a mortgage or something, they were still 3 or 4%. And what that did for the banks, I think that the real purpose of zero interest rate was to recapitalize the banks after they lost, most of them lost all their capital during the financial crisis, without having to pass any legislation, without there being, Congress actually giving money to the banks. But the effect of paying depositors zero when the banks are still lending the money out at 3 or 4% was to cause bank profits to be very large during those years. And that's, if you look at it, I think you can see that most of the big banks got very healthy during those zero interest rate years.
Yeah, I mean they certainly did, but banks weren't really lending like they were before either. I mean the standards were a lot higher, so they weren't actually lending a lot. So it always was kind of a puzzle to me, and sometimes the spreads weren't as large as you would have thought. Um, I don't know. I've just seen banks as just not the best investment in the last, like, I don't know, whatever it is, 15 years.
Well, I'm not saying that banks were necessarily a great investment, but they were able to. They probably mostly all had negative real world equity after the financial crisis. And zero interest rates was one way, I think, for the Fed to allow the banks to generate profits, pretty low risk, because they were borrowing their money at zero.
So, I mean, what about now when you have the inverted yield curve and pretty much the last, whatever it is, 18 months, when, is it 2 years ago? I can't remember. Time flies so quickly. Over a year ago when you had SVB and Silicon, you had Signature Bank and First Republic went under because they had they're upside down in their bond portfolio. How do you see that now with the higher rates? Like, how is that impacting the banks?
Well, I think, and I haven't gone through, but so Silicon Valley Bank had disclosed, right, because they got rid of, one of the things that they did after the financial crisis was get rid of the mark-to-market rules, which some people blamed the financial crisis on the mark-to-market rules. But obviously, just because you're not marking to market doesn't mean that the assets on your balance sheet maintain their value, right? They maintain their value for accounting purposes, but not necessarily for real world purposes. And so I haven't confirmed this, but I've read that the banking industry today has somewhere between 600 and 800 billion of these kind of unreported losses. They're kind of probably disclosed in footnotes and stuff somewhere. So, I mean, it's got to be the case that interest rates being, 4 or 5 instead of 0 or 1 has put a real hurt on the owners of a lot of those assets, which the banks are big owners of that.
Yeah, I know there's one bank that has given the upside down nature of their portfolio is in big trouble if uh, they don't get bailed out. We'll all be in trouble if they go under. But I don't want to name it on the show because that's we're gonna get in trouble. But anyway, no, it's interesting to see because I mean the banking system has changed quite a bit in the last 15 years, and so let me just kind of take a step back because we're obviously talking about risk, but working for the World Bank, I assume you have a pretty keen nose for risk. How should people be thinking about risk in a portfolio? Right now we're talking about some risk, but like, how should people be thinking about it?
I think they should be thinking about risk. Probably for most individuals, the most useful way to think about risk is the risk of each individual not being able to achieve his or her goals, right? Which is obviously that way of presenting it. I can't write academic papers and do fancy math and say, here's risk, right? I mean, the way that we all learn about risk in an academic setting or even on Wall Street type setting is some variation of standard deviation of returns, right? It might be negative semi-variance, it might be value at risk. There's all these, but they're all basically mathematical versions of the same thing, which is basically some attempt to use volatility to measure the likelihood of some negative event occurring. And I'm not saying that's wrong, but I'm saying for the individual. So, for example, if you take somebody, take a 30-year-old, and let's say that person is earning a good living and has good prospects, most of that person's capital is actually in the form of human capital, right? And so human capital there's lots of different ways to define it, but one kind of cold financial way to describe it is it's the present value of the expected future earnings, right? And so if somebody is earning a good salary, let's say they're earning $100,000 a year or something like that, with the expectation that it's going to increase and they'll be able to save a certain fraction of it and all that, that value compared to their financial capital, which is probably just what they've saved and their savings and their 401k and whatnot, right? If you're 30 and you're earning $100,000, you probably got anywhere from not very much to several $100,000 that you've managed to put away, right? On average, obviously there's, but let's say that even that 30-year-old has $300,000 in, which would be a lot in a 401k. That's small compared to the value of the human capital, right? Because the human capital is expected to produce $100,000 a year for the next 30 or 40 years, however long the person's working or more. So that person's risk profile, I would say, don't worry about the volatility of the portfolio. Maybe even go close to 100% equities if you're comfortable or something like that. But that doesn't mean that they want to do that for their whole life, right? And if you have somebody who's retired, depends entirely on how much capital they have, right? And so maybe they'll count on Social Security for something. But if you take somebody, forget all that stuff. If they just have to live off their capital, risk is going to, if you take choose the age at which somebody retires, 65, right? Today, a normal, healthy 65-year-old can probably expect to live 20 years or more. So even if that person retires with $1 million and is going to live just off that $1 million, the risk is, does that $1 million last long enough, right? And so it's not just the risk of investment. It's not just how much is the stock market going up and down. It's how much is the purchasing power of the dollar decreasing, and how long are they going to live? So there's no easy way to, and there's for sure no one size fits all. mean, there are ways to kind of model it, and try to choose the level, there's no such thing as riskless, but you can choose which set of risks you're willing to bear. So, for example, the thing about outliving your money or not outliving your money, that's why the traditional fixed lifetime annuity exists, right? Because if you buy one of those annuities, you're transferring the risk of your life expectancy to the insurance company. In today's world, those annuity products, at least the ones that I've seen, tend to be complex and hard to analyze, at least for me. I'm not an expert in them, but if you're worried about the living too long risk, that's certainly one way to look at it. Inflation is much, much, much harder to hedge against. The theory, and we actually wrote about this a couple of years ago before the big inflation of the last couple of years, but I did an analysis of TIPS, the Treasury, what do they call it? Treasury Inflation
Inflation
Protected
protected
Securities.
security.
Yeah. And Kirk, I think if anybody but the government offered those, they would be restricted to accredited investors. And the reason I say that is they're complex and hard to understand financial instruments. They have options buried in them. They have weird tax rules where the taxes don't follow the cash flows. And so anyway, we did this analysis. Oh, and by the way, I think they adjust with CPI and maybe chain CPI. I can't remember. But anyway, the number that they adjust to is not most people's effective inflation rate. But anyway, what I thought was what analysis that we did suggested that because every year, so TIPS are issued as 30-year notes or bonds, but every year they adjust the principal, but you don't get the principal, but you have to report it for income tax purposes. And so I hypothesized that if there was big unexpected inflation, a lot of people were going to get an extremely nasty surprise and say, what in God's name am I doing with this thing? It's causing me pain. It's not helping me at all. And they're going to dump them. And that's exactly what happened. If you look at the chart, TIPS got crushed when inflation was its highest. And so I think you got to be really careful with things like that. And then the third risk is the one that most people focus on, which is the volatility of whatever it is you're invested in. And the nice thing about that is, well, it's not nice, but we have a lot of historical data. And, we know, at least if the future is at all like the past, we know that if we're invested in the stock market, we can probably expect average annual volatility of something like 15 to 20%. So you can at least, make some kind of projections is the wrong word, but essentially sensitivity analyses. Does that make sense?
Yeah, no, I appreciate your explanation of this. It's funny because as I was listening to talk, I mean it's very much in line the way we think is that, most of Wall Street talks about risk management and really what they mean is volatility management. Which is funny because I don't think most people understand risk management. I think it's a very different thing than volatility management, but a lot of the risks you talk about are very true risks, like, time value money and things like that. Um, but I was laughing when you started talking about tips because people have been talking about tips for like the last 4 years, and they're like, tips, they're great, they're going to do great. I'm like, I've been doing this for a long time. I don't fully understand tips. And I appreciate you. You've got a PhD in economics, and you're telling me you don't understand. That makes me feel better. It makes me feel like I'm not an idiot because I'm like, I don't understand. These things are supposed to operate this way, and they don't. Like, you can follow the ETF, the TIP ETF, and you're like, why is this thing operating differently? So I appreciate you sharing that because I've asked so many people, like, I don't understand. Shouldn't these go up? They're like, no, 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 they'll be fine. I'm like, really? Because it's not operating the normal way. But yeah, I still don't understand. Even after you explain, I understand what you said, but it's like, have you have you been able to actually figure it out, or you just kind of like ballpark in the direction?
So I did this analysis before inflation went up. So we wrote a book in, I think it was published in 21 about inflation. And one of the things that I was looking at was tips, because it's one of the things that everybody up until a couple of years ago was saying is such a great inflation hedge. And I looked at them, and that's when I discovered that it's, tips are this fairly complex package of, attributes. Um, and it's probably the case. So forget um, the risk that the inflation index that tips follow isn't real world inflation. Forget that. Let's just assume that it was. If you assumed, I think, if you assumed it actually tracks the inflation you care about, and you don't have to worry about taxes, and your time horizon is 30 years, and you're not going to need the cash between now and then they should be fine. But very few of the people and the investors at whom tips are aimed, very few of them would, all three of those assumptions would be satisfied. I mean, there are, I mean, even Buffett, who claims to always have this infinite line time horizon, doesn't act like it. I mean, almost no one does. I mean, humans just don't. Maybe some institutions do, but there are probably, if you really truly had a 30-year time horizon, you would probably find that there were a lot of things if you were worried about the value of the dollar, a lot of things you'd rather put your money in than tips, I think.
Yeah, one thing that Wall Street does well is overly complicate the investments so that most people can't understand how they actually operate, and they think they do until they don't. So I'm not surprised that this product exists because it's perfect for Wall Street. But it is interesting. I mean, it's an interesting product on its surface, just when you dig into the weeds. So I appreciate you sharing that. All right. So another few things we talked about before the show. There's a few areas I wanted to talk about, but certainly these alternative assets which sometimes come in a portfolio like gold or farmland. How do you look at things like that when it comes to a portfolio?
So I would look at gold very differently than I would look at farmland. So gold, strictly speaking, isn't really an investment in the sense that an investment is deferred consumption so that you can put that production to use in a way that's supposed to create more future production. Gold is historically money, right? I mean, the gold as money goes back as long as we have records, pretty much. And even today, when gold is not officially money anywhere, although I did read something about, didn't read it closely, but something about BRICS, 40% gold backed currency. I don't know if that's a real happening thing or not. But gold's not officially anywhere money. But if you look at the behavior of the world's central banks, all the big ones have large gold holdings. And except for a few weird political moves like Gordon Brown selling off half the UK's gold in the 90s, they don't let go of it, right? The IMF has gold, the Bank for International Settlements has gold, the Fed has gold, or the Treasury, whoever owns it, it's on the Treasury, on the Fed. I think it's on the Fed balance sheet. So gold, talking about volatility, gold is quite volatile, at least in terms of US dollars. And it's not a perfect inflation hedge over the short run by any means, right? You remember from 1980, the actual dollar from between 1980 and about 2000, the actual dollar price of gold declined fairly jaggedly from about 800 to 250 or something like that. And that's not even counting inflation. So there was plenty of inflation in the US dollar between 1980 and 2000. But if you just had your money in gold, you lost money measured in dollars. Now, if you still hold that gold, you're doing fine. Depends on when you bought it, what you paid, but the role of gold in a portfolio, Kirk, as I see it, is sort of like disaster insurance. Unforeseen. It's the economy is not, if the economy is working right and inflation's under control, gold's probably not going to do all that well. But when things start to come off, the wheels start to come off, gold tends to do better, which it's done for the last 20 years, right? From that extraordinary low, the Gordon Brown low. Because, I mean, Gordon Brown, I don't know if he's still around. Is he still around?
I'm not sure. I don't follow the politics over there, but I haven't heard the name in a while.
But if there was such a thing as political malpractice, he would be guilty of it because he not only sold off the UK's gold or half of it, but he like pre-announced it. And so all the bids backed up and they got crap prices for it.
Kind of like Janet Yellen not refinancing our entire debt when it was at 0%. Kind of like that kind of that was a big mistake too.
Something like that. Yeah. Yeah. But anyway, so I think, historically adding a relatively small fraction of gold, 5 or 10% gold equities to a portfolio can reduce the overall volatility and kind of moves you to up and to the left on the so-called efficient frontier. Mm-hmm. Farmland, which you also asked about, I think is a completely different animal. Farmland is basically just a land investment that has some yield. And so the vast majority of farmland in the United States is never going to be anything other than farmland, right? I mean, obviously there's famous stories. We've all heard them. People buy farmland and then the city expands out and their stuff went from being, worth on the order of $1,000 an acre to the order of $100,000 an acre. Obviously, that's not what we're talking about. That's land speculation. And if you know what you're doing, you can make a lot of money, but most people underestimate the difficulty of doing that successfully. And so farmland is essentially what produces the value of farmland. So most farmland, I think the slight majority is actually owned and rented out to people who farm it. We're talking cropland. And so they rent it out for something called not surprisingly, a cash rent. So your cash rent divided by the value of the land gives you something called a cash rent yield, right? You can think of it as the yield, like a yield on a bond or something. Your cash rent yield is then the flip side of that is the cost to the farmer, right? So the farmer has inputs, and the inputs are labor and seeds and equipment and fuel and fertilizer and those kind of things. And plus he's got to pay a lot of them have interest to pay. And a lot of them also, as I said, rent the land. So they got rent to pay. So in a competitive market, and farmland is a pretty competitive market, the rents can't go above the amount that the farmers are willing to pay, and the farmers are willing to pay it because they can afford to rent it and still earn a decent return on growing the food or whatever it is that they're growing, cotton or And so what's the output? The output is the product, right? It's the grain or it's the cotton or whatever it is. And so there's two things that drive the revenue. So if you're a farmer, you've got your costs, you've got your revenue. Your revenue is your product sales, right? And there's two factors to that. There's how many bushels of wheat do you sell and what price per bushel do you sell at, right? And most farmers have very little control over those, right? They have no control over the price. And the weather is going to determine the yield to a large extent, right? So if you do everything right, you're still at the mercy of the weather. So the revenue that the farms can produce is going to be a product of the quantity of stuff that's produced, the yield per acre. If you're talking about it on per acre, you can only grow so much stuff per acre, and the price per bushel or whatever the measuring unit is. And it turns out that right now, Kirk, or recently, both of those are near all-time highs. So I think farmland in the US anyway, the average Midwest acre is much nearer a top than a bottom in terms of valuation for three reasons. The yields, these cash rent yields are low, and the actual physical yield is quite high, and the prices of the farm products are quite high. So it's hard for things to get a lot better. It seems like there's a lot more downside than upside.
Yeah, it's interesting. I've always been interested in farmland. It's been the whipping boy for a few decades. It's kind of come back into favor a little bit in the last few years, but um, it's just always fascinated me. It's such an interesting asset class, and yet farmers can't make money on it. You know, it's just this weird thing that I guess if you're in a niche, it can be very profitable from the numbers I've seen, but generally it's like, you know, people out in Montana, they're barely making it, barely, you know, pinching pennies to make it work. They're asset rich, but they're cash flow poor. I mean, it's
Well, that's
really
exactly right. And that's basically, that translates into this, 3% rent yield. And so, yeah, there are people willing to buy it. And people complain the Chinese are buying it, Bill Gates is buying it. I don't know if it's true, but it doesn't necessarily mean that it's a good investment.
well, they're definitely buying it. That part's true. It's just, you know, like you said, the investment part, why they're buying it, who knows? And I haven't met many. Well, you know, Jim Rogers wrote that book. It was a commodity something or other, commodity bull market or something like that. But he talks about the farmers gonna be driving Lamborghinis. I'm like, that's not happening. You know, they're not making much money. I mean, they have money, but they're not making much money. So it's only in a handful of like really carved out areas, niches, have I seen people actually be able to be profitable. Otherwise, it's like corn, soybeans, you're looking at what, like a 3 to 5% yield, something like that,
You
which
mean depends yield for whom?
including appreciation. Um,
Oh yeah. So I mean that's where all the profitability of owning farmland has come from the appreciation, not all of it, but a large share of it.
yeah.
In fact, we did an analysis on where have the returns for farmland come from. And when interest rates were falling, you could explain a very high fraction of the increase in farmland simply by watching the falling interest rate, right? And that, it's like we talked about at the very beginning, right? The value of an asset is the present value of the future cash flows. Well, the inflation adjusted cash flows from farmland don't vary all that. I mean, they have a lot of intra-year variation, but the long run trend is, it's a competitive market, right? I mean, there's thousands and thousands and thousands of, maybe millions of people growing the product around the world for most of these products. We're talking about the big international commodities, right? Which is most of the US farmland: corn, soybeans, wheat, And so you expect it to be an efficient market, and it is. And so the returns are basically, well, essentially you have the multiple rising, right? If you think about it as a stock, from the bottom, I forget the numbers exactly, it's in the book somewhere. The multiple on farmland went from something like 10 to like 33 or something like that. That's how you can think about it. And that's where most of the return came from. But
Yeah.
if you take a very long-term view, farmland in the US anyway, at least as much as we have data on it, has had very long, like generationally long cycles, up and then down. And so have interest rates. And I think those are probably pretty closely connected.
Yeah. Yeah, I would tend to agree. Well, as we kind of wrap it up here in the interest of time, Roger, final thoughts from you and kind of practical takeaways that you can give our listeners.
Well, I think people, if they don't already know a lot about investing, I think you can get very high, the learning curve, you can learn a lot even in 50 or 100 hours, which is like an hour a week for a year, hour or 2 week or 2 a week. And especially if you're young, anything that you learn now that's correct, right? You don't, kind of funny for me to be saying this to you because we're being viewed on some form of social media, but there's so much nonsense out there. You got to be careful about where you get your information from. There's no rocket science in investing, right? There's some math, but not anything that is too complicated for most people. And you can understand most of what you need to understand. And you're not trying to necessarily beat the market. If you can get the market returns and not beat yourself, most people should be able to succeed.
Awesome. Well, Roger, where can people find more about you?
So the company is Sterling Foundation Management. The best way to get us, well, easy way is call. Give a phone number, Kirk.
Sure. Yeah, whatever you need.
Yeah, 703-437-9720. 703-437-9720. You can look us up. Sterling Foundation Management. The website is www.sterlingfoundations. So it's STERLINGFOUNDATIONS.com. And then if people are interested, particularly in investing and learning what they need to know, we wrote this book called The Investor's Dilemma Decoded. I don't know if it will show if I try to show it to you here.
No, I won't see it. We'll put it on the website. Just send us a picture. We'll put it on the website.
Yeah.
Awesome.
Yeah. Okay.
Great. Well, I appreciate you coming on, Roger, sharing your wisdom with us. Always love learning new things and feeling that I'm not alone with the tips problem. So thank you.
Yeah, Kirk, I appreciate it. Thanks for the time.
All right. Thanks for coming on.
Good to talk to you. Thank you. Bye.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show, and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right, well, that was a great interview with Roger. Really appreciate him coming on the show and sharing his wisdom with us. And now we're into the panel portion of the show where we have our very own Barb Freeberg. Hey, Barb.
Hi, I am so excited to talk about Roger Silk. That guy has so much knowledge.
Yeah, this will be a fun one. We also have our very own Phil Weiss. Hey, Phil.
Hey, Kirk, I'm excited to talk about what Roger had to say. I was surprised. It was not what I expected, but in a very good way.
Awesome. Well, let's dive right in. So, Barb, you were glowing recommendations for Roger. What are your thoughts? What were some of your takeaways?
He covered like so many important topics. The benefits of investing in treasuries, which, you know, I've invested in those for a long time, and the fact that they are state and municipal tax free, and they're pretty secure, and they're super liquid, great for your cash allocation or even your short-term bonds. Loved his discussion on risk. I know we're going to delve into that later. And even the stuff he talked about with regard to gold, farmland at the end, I thought he provided some really interesting intakes. So, guys, I am ready to dive in wherever you want to go.
Awesome. Great stuff. And Phil, what were some of your takeaways?
So one of the things that really surprised me was when he talked about risk. I just loved how he described it. And I know we're going to talk more about that, but it just tied so well into the way I think about it, which doesn't mean that that makes it right or wrong, but I just was surprised to hear somebody with his background discuss risk in the way that he did. You know, I love what I was really fascinated by not just treasuries, but when he talked about tips, because I've read these articles on places like Advisor Perspectives talking about like you should use tips and just ladder them out for your whole retirement, and it's such a great thing to do. And they're not nearly as simple as any of those articles make them appear. Uh, even when he talked about the farmland and the gold was really interesting, and then also he talked about trying to generate what it meant to get market returns, like, and not to chase returns. Even that part I was really good too.
Nice. Well, let's dive right in. Let's start with risk. So, Barb, what were your takeaways from this with the risk conversation? Because risk is obviously a big part of investing.
The first answer to your risk question, Kirk, was having enough money to meet your goals. And I've heard this a lot recently as I edge up into those later years, is that when you have enough, you're done. You don't have to keep playing the game. And so to work with a good financial planner or to use a reasonable retirement calculator and just figure out how is the best way to devise an investment portfolio that is likely to meet your goals for the long term. Nothing's perfect, but that is numero uno. You have to be able to meet your goals. And, maybe less important if you're 30, 20, 40. But when you get into your 50s, you want to really structure your portfolio so that you can meet your goals. And volatility, like standard deviation of your returns, is frequently calculated as the risk. And that's why stocks are considered very risky assets, because their value goes up and down a lot more than bonds or cash. And if you're willing to put up with that kind of volatility over time, you're likely to get much higher returns. So that's important too, but it's not the only measure of risk. So I implore all of you listening to really evaluate not only your asset allocation, but also, are you on a path to have enough assets to meet your goals, whatever they might be?
Yeah, thanks, Barb. Phil, what about you? What are some of your, I know you have a lot of experience in this too. What are your opinions on risk and kind of some of the things that Roger said?
So I don't like to think of risk as volatility because the more I know everything fluctuates, usually I think of risk in two ways. And one of them is the risk of loss. Like that to me is much more relevant than volatility. But Roger talked about, I wrote it down because I liked it. Not, he just said simply not being able to achieve goals. That's what risk is. And that's something I talk about with clients all the time. We have these goals, right? We have a financial plan. Our goal isn't to beat the market because if we try to beat the market, we're taking on more risk. And if we take on more risk, if we're right, well, that's great. But if we're wrong, then you're going to lose and you're going to lose more than the market does. And the last thing I want to tell a client is that you can't do something that was in your plan that was really important to you. I had a conversation with a client just yesterday, and we were talking about her portfolio and what the returns are. And, they're not market returns, but she doesn't need market returns. And she's like, well, well, my friends are earning this. I said, yeah, but if I look at your financial plan and I look at your goals, you're on track to do all these things that you want to do. We can increase your stock allocation and up the level of risk in your portfolio. But if that ends up costing you what you want to do, is that worth it? Probably not. That's not a conversation I want to have with a client that, hey, these things that we said we were going to do, we can't do them anymore. So to me, it's more important to be able to structure a portfolio that allows you to live the life, your most fulfilled life, what you want to do, and doesn't leave you worried that you're not going to be able to do that. A lot of times I'll ask people, what's important about money to you? And the two most common answers I get to that question are freedom and security. And if we can invest in a way that allows you to achieve your goals and live the life that you want, really we're giving you both those things, right? We're giving you the freedom to live the life that you want. And we're giving you the security to be comfortable that you can. So if we think about it that way, that's a better way to think about risk, is the risk of not being able to achieve your goals or to live the life that you want, however you want to characterize it. I think those things are so much more important than going out there trying to chase the biggest return.
Yeah, I think those are great perspectives. And yeah, it's interesting. I was just thinking about it as you guys were talking about it. It's funny. I always like interviewing people because you get different perspectives and different frameworks on how to think about the same topics that we talk about all the time. And something you were just saying, Phil, just caused me to think about something differently, which we talk about the show a lot. There's a difference between risk and volatility. Risk is, I would characterize it as a permanent impairment of capital, which means you invest in a company and it goes to zero. That's permanent impairment of capital. Or you buy some company and it goes down a lot and never comes back. Like that's permanent impairment of capital. Volatility is just basically the motion sickness, the motion of the ocean, as they say, right? It just goes up and goes down, goes up and down. I would say the risk in volatility is the risk of you getting off, right? Getting off the roller coaster. Goes up, goes down. The risk in volatility is the risk of you getting off. Going up and down is not risk. It's volatility. Those are two different things. But when you get off, that is a risk. So I would say I've corrected my point of view from what I've always had, but I think that it has to be really couched properly, is that the risk of volatility is you getting off. It's not volatility itself, because that is not risk. But if you get off, certainly it is. So I do want to kind of dip back into the water that Roger was talking about, and you guys have mentioned about U.S. Treasuries. So we talked about U.S. Treasuries. We talked about tips. Tips are a weird investment. But what are your thoughts on Treasuries and tips, Barb? I mean, we're in a interesting environment. Rates are starting to drop again. What are your thoughts?
I'm invested a lot in short-term treasuries. I'm also older. I don't have a lot of human capital left. In fact, I have very little, which means I'm not going to be working and earning any big time money going forward, as was the case in the decades before. And so my portfolio leans towards the conservative because if there's a big stock market drop, um, I don't want to feel like I have to sell my assets. Thus, I have a very large cash type cushion. And frankly, personally, because I'm very risk averse, I've always had a much higher allocation to fixed assets and cash than one would think for my age. And so that said, I like treasuries because they are secure, from short-term treasuries to intermediate to even long terms. And you can get these just buying them in the open market through your brokerage account or in an ETF or mutual fund. And they give you a sense of security. So you're going to get a little bit of return. Like I said, you're not going to be taxed on for state and local taxes. And if you're like the three of us and live in high tax states, that makes a difference. My marginal tax rate in California is like 10%. So, you know, you knock that off and I'm getting a pretty decent return. So, advocate of treasuries. Tips I have invested in for a long time, as I have invested in I bonds. And it was really nice to hear him talk about tips because I thought I understood what they were, but then they didn't really perform in the way that you would assume they would, which is to protect your capital from appreciation. And just as a quick primer, tips are issued with a principal and an interest payment. And the interest payment is fixed throughout the life of the tips. But the principal value theoretically goes up or down in line with inflation. So if inflation goes up, the principal value of the tips will go up and you'll receive that fixed interest payment on the tips. But the problem is, for whatever reason, I'm not really sure, and it didn't sound like Dr. Silk was really sure either. They don't really perform in line with inflation. So, yeah, I'm in a tips fund and it hasn't really performed in line with inflation. And truth be told, I've been kind of lazy and I've just kind of watched it. I haven't really done anything. And my hope and expectation is, and Roger alluded to this, over the long term, it should all play out that it is an inflation hedge. So count me kind of on the fence. I'm an investor in tips. I have some I bonds. I've invested in individual tips in the past. Do they protect against inflation? You know, I'm really not sure.
Yeah, it's a boggle to me too. I understand tips as you do, Barb, but I don't understand how the price movement, which is why I've never invested in them because I just don't understand it. And like I said, I understand it, but I don't understand the output. What it should be is different. You know, so if you look at the ETF TIP, you know, started around 130 and went down to a low of just over 100, like 103 or 4, something like that. Lost a lot in 2022. And then it's pretty much been going flatlining since then. Now, I'd imagine the logical solution is, well, they'll naturally go up from here. But what does that have to do with inflation, right? Inflation has not, is, if anything, it's declining. So it just kind of brings up some questions that just don't make sense in my mind is, you know, what are you really investing in? Well, if you're doing that, why don't you just invest in like TLT? Why bother investing in the tips if you're just kind of going against the grain with interest rates? So I've also been puzzled, which is why I don't do it. But one other thing I've been puzzled about, and I'm going to ask you, Phil, too, is I've always found this comical. If you invest in municipal bonds, they're triple tax free. So the federal government, the state government, and local government do not tax you on your income from municipal bonds, which is great, right? So this is a state bond. all of the government entities have allowed you to be triple tax free. But for US Treasuries, they say, well, you don't have to pay state or local taxes, but you got to pay taxes on the federal level. Well, these are federal level instruments. So they're basically strong arming everyone else to not have to pay taxes, but you got to pay our taxes. That's not, I mean, what's wrong with this picture? Shouldn't they be saying you don't pay federal, but you pay state and local? I mean, to me, it's just, I don't even know how they strong arm them to do that, but it just seems like ass backwards. Anyway, Phil, so what are your thoughts on treasuries?
I like treasuries a lot. After 2022, I largely for the fixed income portion of client portfolios, I abandoned the ETFs because one of the things that I noticed as I looked at their performance is that they own a bucket of securities, a bucket of bonds. And when rates start to move, you don't get the same movement in your yield on a ETF as you would if you owned a bond itself. Because they're not going to say, oh, well, rates went up or rates went down, so now I'm going to sell everything and replace it with what's current. That doesn't happen. So you have a lag in terms of what kind of yield they provide. They also have more volatility than I like. So I looked at treasuries, and they become a little bit less attractive now because rates have fallen some. But I looked at treasuries and I said, when I buy a treasury, I don't really care what the stated coupon or interest rate is on that treasury. I worry about what the yield to maturity is. And what that basically refers to is if current interest rates were 5% and the treasury is only paying 3%, I'm going to pay less than $100 for it because to get that market rate, I have to be able to buy it at a discount. And then over time, as that treasury moves to maturity, the value goes up to 100, which would be par value. So I get the return from the coupon or the interest plus the growth to get back to par. So I look at that yield to maturity, and that represents the sum of those two numbers. When I buy a treasury and my intent is to hold it to maturity, I know what my return is going to be. I don't go out long. I don't do the 30 years. At one point, I was doing 10 years when 10-year rates were over 5%. Now they're a little over 4%. I'm not going out more than 5 years, but I can get a 5-year ladder where I buy equal amounts for each year. And I know that the return on the fixed income portion of a client's portfolio is going to be around 4.5%. If we're holding to maturity, that's what we're going to get. I don't really worry about them defaulting. So I kind of feel like I know what that return is, and I like that. It's a high quality instrument. I tried some other things, looked into some other things that I didn't really like. I think treasuries are a really good way to fill that fixed income portion of your portfolio in the current environment. Tips, like you said, I understand the concept, but the performance doesn't seem to match. As I mentioned earlier, I think I've seen people that have talked about, well, you can build out like this whole big long ladder of tips that take you out for 30 years if you want. But I'm not comfortable enough when I look at how they performed. It doesn't always seem that the price movements in them make sense based upon my understanding of how tips are supposed to work.
Yeah, no, that's great. So, Barb, as we kind of get close to wrap it up here in the interest of time, what are some final thoughts you can kind of share with us, similar to the conversation we had with Roger? He talked about some other things. He talked about gold and farmland, but what are some of your takeaways, and what should people take away from this so they could apply practically today?
Well, one thing that Phil said that hit me when he was talking about the 5-year yields that you can currently get around 4.5%. Well, if we can assume that inflation will return to historical levels of between 2 and 3%, which, I think we're getting there. What that's telling you is that the treasuries are actually beating the inflation protected securities or are beating the inflation rate. Now, is that always the case? I haven't done a study on this, but I think in many cases, yeah, it is. So, and treasuries are secure. If the US government goes to pot, well, we're going to have bigger problems than worrying about our treasury bonds. So, with regard to alternatives, which Roger also talked about, ho-hum. Okay, let's just leave it at that. You can find me at Barbara Friedberg Personal Finance and on my YouTube channel, Barbara Friedberg. Thanks for having me on.
Thanks for coming on, Barb. And someone who's not ho-hum, what's Phil, what are your final thoughts?
So, Barb, thanks for mentioning that about treasuries, because that's also was part of my thought, is that 4.5% is more than inflation. And I don't know about all of history, but if we go back to that zero rate environment, right, when treasuries were paying 0 to 0.5% and inflation was 2%, you were losing. Now we're ahead. So like that's another reason that I like treasuries, this environment, because we often talk about the idea that when you're investing, one of the reasons you do it and go into the stock market is to stay ahead of inflation. Right now, treasuries are letting us stay ahead of inflation too. So I can have something in my bond portfolio that I feel is really safe, that can outpace inflation. So, like I said, if I go back to the beginning, like my biggest takeaway from what Roger said is something that I think about all the time. The importance of risk being not being able to achieve your goals. It's not about volatility. There's things that you can do to protect against that. We don't want to have permanent loss of capital, like you mentioned, Kirk, right? That to me, the risk of loss, like, and so there's things you can protect against that. I like to think of having a certain amount of cash when I have a retiree that's drawing their portfolio down, because that way we don't have to sell low, right? We can wait for recovery. So just think about the idea that your risk is really not being able to achieve your goals. That's my biggest takeaway. He said a lot of other great stuff, but that to me is the key behind what Roger talked about today. As for me, I know that experiencing big life transitions can be stressful. My job is to help empower women facing new beginnings with the financial knowledge and tools they need to make self-assured decisions. My firm's Apprise Wealth Management. We'd love to get to know you. If you'd like to learn more about us, you can download our free ebook, How to Flourish Through Life's Big Changes, at apprisewealth.com/ebook, and you can also sign up for our blog. Thanks for having me today, Kirk.
Great. Thanks for coming on, Phil. Thanks for coming on, Barb. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.